As of the market close on Friday, November 28th, Rivian Automotive Inc. is trading at $16.86. We witnessed a solid intraday push of 68 cents, translating to a 4.20% gain. If you are checking your brokerage accounts over the weekend, you will see that the momentum didn't entirely vanish when the closing bell rang. In the after-hours session, the stock managed to creep up another 4 cents to $16.90. A slight 0.24% addition. On the surface, a 4% gain on a Friday feels like a victory lap. It feels like the market is finally giving this beaten-down EV contender the credit it deserves. You look at that green percentage and you think, okay, the turnaround is here, the bottom is in. That is the expectation, that this is the beginning of a smooth, linear ascent back to the glory days of the IPO. But the reality of this price action is far more complex and, frankly, far more precarious. What we are seeing isn't necessarily a flood of new, long-term capital rushing in to hold the stock for the next decade. Instead, we are looking at a technical squeeze combined with a very specific repricing event driven by analyst chatter and the digestion of recent corporate maneuvers that are much messier than the headlines suggest. While the green looks good on your screen, the volume profile and the specific nature of the buying today suggest a battleground, not a victory parade. We need to peel back the layers of this 4% move because if you treat this like a simple buy signal without understanding the mechanics underneath, you are walking blind into one of the most volatile sectors in the entire market. Let's dissect the intraday movement we saw on Friday. The stock didn't just drift higher, it marched. This wasn't the erratic, choppy trading of a confused market. It was a sustained bid. This usually indicates that institutions, the big funds managing Fidelity mutual funds or those allocating for Schwab Intelligent Portfolios, are stepping in to defend a level. For weeks, Rivian has been trying to find a floor, and every time it dips toward the mid-15s, buyers step in. Friday's action was a confirmation of that support. However, we have to talk about the elephant in the room that hit the news cycle just before this weekend. CEO R.J. Scringy selling stock. Now the headline reads, CEO sells shares, and the immediate retail reaction, the reaction from guys trading on the Robinhood app or scrolling through SoFi investing feeds, is panic. Why is he selling if the future is so bright? Here is where the expectation versus reality dynamic hits you hard. The expectation is that an insider sale is a vote of no confidence. The reality is that Scringy sold about $263,000 worth of stock under a Rule 10b5-1 trading plan, which is a prearranged schedule. In the grand scheme of his holdings, which are in the millions of shares, this is a drop in the bucket. It is negligible. But the market's ability to shrug off this headline and rally 4% anyway is the real story. It tells us that the fear narrative is losing its grip. When bad news, or news that looks like bad news, fails to send a stock lower and instead it rallies, that is a massive divergence that you need to pay attention to. It implies that the sellers are exhausted. The people who were going to panic sell have already left the building. We also have to look at the catalysts fueling this specific Friday move. Late in November here, we are seeing a wash of analyst adjustments. Stifel recently raised their price target to $17, and Tigris Financial is waving a bull flag with a target as high as $25. When you see a stock trading at $16 and a major firm says, "We think it's worth $25, that creates a vacuum. Algorithms that scan for price target upside immediately start buying. That is likely what drove a significant portion of Friday's volume. But be careful. Analyst upgrades are often trailing indicators. They upgrade after the company shows progress, not before. They are reacting to the same news we are, the Q3 earnings and the Volkswagen deal. Speaking of which, we cannot analyze this $16 price tag without doing a deep dive into the financials that were released earlier this month. The Q3 2025 earnings were a pivotal moment. The expectation going into that report was arguably grim. The EV winter narrative has been hammering stocks like Tesla stock and Lucid, and the fear was that Rivian would show a massive cash burn that would frighten away the last remaining bulls. The reality: they beat expectations. Rivian posted a loss of 65 cents per share, which, while still a loss, was significantly better than the 74-cent loss the market feared. Revenue came in at $1.56 billion, beating the $1.52 billion estimate. Why does this matter? Because in a high interest rate environment, and we all know rates have stayed stickier than anyone wanted, losing less money is almost as good as making money for a growth stock. It shows discipline. It shows that the path to profitability isn't just a slide in a PowerPoint deck, it is actually showing up in the bank account. The company generated a gross profit of $24 million for the quarter. Pause on that. They made a gross profit. That means they are finally selling these trucks for more than the direct cost to build them, excluding the massive overhead. That is the turning point every manufacturing company dreams of. However, we must temper this with the darker reality of the EBITDA miss. While they beat on EPS and revenue, the adjusted EBITDA was still a loss of $602 million. They are still burning cash at an alarming rate to keep the lights on and the R&D labs running. This is why the stock is $16 and not $60. The market is effectively saying, okay, you proved you can build the car, and you proved you can sell the car, but can you run the company without incinerating $1 billion every few months? That question has not been fully answered, and that is the risk you take when you click Buy on your interactive broker stock trading screen. Now let's look at the Life Raft, the Volkswagen joint venture. This is the single most critical component of the bull thesis right now. The deal is finalized, with a potential total investment size of $5.8 billion. Expect Rivian gets cash, VW gets software. Reality? This is an existential validation of Rivian's technology. Volkswagen, one of the largest and most experienced automakers on the planet, looked at its own software stack, looked at Rivian's, and effectively admitted yours is better. They are paying billions, not just for a partnership, but to save their own digital future. For Rivian shareholders, this does two things. First, it removes the immediate bankruptcy risk. With billions in fresh capital and a partner like Volkswagen, the lights are not going out anytime soon. And second, it transforms Rivian from just a car company to a tech platform. If they can license their zonal network architecture to Volkswagen and potentially others, the margins on that software are infinitely higher than the margins on bending metal for an R1T. This is the AWS moment potential that keeps the bulls awake at night dreaming of triple-digit returns. But we have to look at the product timeline because stocks trade on future cash flows, not past glory. The R1 series, the trucks and SUVs you see on the road today, are fantastic, but they're expensive. They're niche. The future of the company rests entirely on the R2 platform. This is the midsize SUV targeted to start around $45,000. Production is slated for early 2026. We are sitting here in late 2025. That means we are in the valley of death, the gap between the hype of the announcement and the reality of the delivery. The stock price is currently pricing in a successful launch. If there is a delay, if we hear about supply chain snags, or if that Georgia plant gets pushed back further, currently slated for 2028, with initial production in Normal, Illinois, this stock will punish you. The market hates delays. I want you to think about the broader sector for a moment. The EV landscape in late 2025 is drastically different from the boom of 2021. The early adopters have bought their cars. Now, companies have to convince the early majority. These are people who don't care about 0 to 60 times. They care about charging infrastructure and monthly payments. With the federal tax credit situation shifting and the demand pull forward we saw in September and October due to expiring incentives, the organic demand for EVs is being stress tested. Rivian is not immune to this. They are fighting for the same customer wallet as the Tesla Model Y, the Ford Mach-E, and a dozen other competitors. The difference is, Rivian has a brand cachet that feels more like Patagonia than Tech Bro. That is their moat. But is a cool brand enough to survive a recession or a prolonged period of high rates? Let's talk about your strategy here. If you are holding this stock or thinking about entering at these levels, you need to understand the volatility. The beta on this stock is high. If the Nasdaq sneezes, Rivian catches a cold. If NVIDIA stock sells off and drags down the tech sector, Rivian goes with it regardless of how good their news is. This is why diversification is key. If you are using Fidelity ETFs or a SoFi robo-advisor, you are insulated. But if you are stock picking in an individual brokerage account, you are exposed to the raw nerve of the market. I want to pause and hear from you guys, because the sentiment on this stock is usually incredibly polarized. Comment below. Are you an R2 reservation holder who is still waiting, or did you give up and buy something else? I want to know if the waitlist demand is still real or if people have moved on. Drop a comment and let me know. Back to the analysis. We need to look at the institutional activity. We know about the Volkswagen deal.